Good morning, good afternoon, and good evening to wherever you are attending this webinar from. For the next little while, I will have the pleasure of your company, in which I tend to take you through a number of matters. Firstly, we'll be tending to the group highlights for 2022, the mining performances for 2022, improvements that we have already made during the course of the first quarter of this year, and we'll be providing some guidance for 2023 as well. I will also overview the diamond market and why Lucapa is very well positioned among the diamond peers in our sector to deliver in an abnormal environment where diamond equities are clearly disconnected from the steep recovery in the diamond market post-COVID. And finally, we'll take some questions that we have received from registrations during the course of the week. Firstly, as always, please take note of the cautionary statements. This presentation is available on the ASX platform and our website. For those who have not visited our website recently, please do so. It has been completely revamped, and I'm sure you will enjoy the new site. As always, if you think there is anything that we can add to it, please do not hesitate to send us your recommendations. In terms of the group highlights and following on from our stated production growth initiatives in recent years, similar to 2021, 2022 was another record year for us here at Lucapa in most respects. I say in most respects because whilst we achieved record operational performances, record cash returns to the centre, and achieved quite significant primary source exploration results, we too, like many others in the resource space, were dealt a few challenges to navigate during the year. But I trust by the end of this presentation, you'll see how we have addressed those challenges, thereby ensuring that our assets are deliverers of value and not consumers of it. Firstly, onto our production assets. You can see photographs there of the LULO plant and the MOTHAE plant. Our teams on the ground and here at the centre delivered some very strong operational performances in 2022, achieving a number of records at both LULO and MOTHAE. These records translated into record revenues, 149 million Australian dollars achieved in rough diamond revenues, notwithstanding the impact of the geopolitical and financial environment that we faced in 2022. At an EBITDA level, combined, the operations achieved just shy of 50 million Australian dollars, a very strong result indeed, and following on from last year's record EBITDA, a very, very stellar performance again. At LULO, we achieved $53 million EBITDA, but unfortunately with the challenges that we faced at MOTHAE, which I will overview shortly and tell you how we have addressed them, we achieved an EBITDA loss of 3.7 million Australian dollars. As a consequence to those constraints and the challenges that we faced last year, we booked a $15 million Australian EBITDA, impairment charge to the income statement, but we believe we have addressed the constraints quite significantly this year, and there's every chance that impairment could be reversed during the course of this year. The improvements that we have made are working well, and with a few more months under our belts, I think we'll be in a strong position to make a call on that. As a result of the stellar performance at the operations, particularly LULO, we had record repatriations from Angola. As you can see, the remaining loan balance at LULO owing to Lucapa is just under 19 million, and with another strong performance at LULO, we could well see that expunged in the not too distant future. We took those repatriations and worked hard to reduce the debt on our balance sheet, and therefore we have strengthened our balance sheet quite considerably by paying down debt to the tune of some 19 million Australian dollars. As we have them scheduled this year, our interest-bearing debt should be fully expunged by the third quarter of this year, and that paves the way for us to potentially declare dividends to shareholders, as opposed to the good returns from our mines coming in and servicing the interest and debt principal payments. We would be in a position whereby we can start putting a portion of the returns that we make there to shareholders, and I think that that's obviously going to be welcomed by the investor market. On to our development assets. Our primary source exploration and development assets also delivered significant results. At LULO, we built and commissioned the bulk sample plant in September. We reaped the benefit of this plan almost immediately as we returned our best exploration results to date. The large number of carats at a decent grade were important, but of most significance was the recovery of diamonds greater than 10.8 carats in size, or specials as we call them in the sector. First evidence of our long-held view that the LULO kimberlites do host the type and size of diamonds we have been recovering almost at will in the alluvial operation. We believe from the many mining blocks and differing diamond characteristics from those blocks that there are multiple contributors or influences to those mining blocks, and that's why we believe we have multiple kimberlite sources. So we look forward to processing all our priority kimberlites to identify the few that will form part of our follow-up program. Importantly, we made very good strides in our majority stake ambitions with our partners. A draft of a new mineral investment contract is currently being worked on by our partners, and we will submit that for approval to the ministry in the not too distant future. We look forward to completing this important work stream soon. We did not conduct any major programs at Brooking or Arapa in 2022, but we do look forward to completing our planned drilling programs on the targets during the course of this year. We also performed some cursory hyperspectral and sampling programs at Merlin on the anomalies that we identified late in the year, but most of the team's effort here at the centre has been focused on the primary reason we acquired the project. Merlin is a near-term development opportunity on an historic 4.4 million carat JORC compliant resource. Historic why? It is home to Australia's largest diamond on record, a 104 carat top white stone. As you can see from the news, the media clipping there, that stone was valued at some or around about $1 million back in 2003. A similar stone like that today will go for close to between $3.5 to $4 million. So you can see what has happened to the price of exceptional diamonds in the last 20 years. As we have seen from the economics of the two scoping studies that we published late in 2021 and early in 2022, an open pit and vertical pit mine development at Merlin has strong potential, and a delivery of a mine will certainly grow Lucapa's production, earnings, and cash flows by multiples, not small percentages, but by multiples. So we look forward to announcing our feasibility study, which is well advanced. However, as noted to the market, we are still awaiting certain inputs from consultants. So we've had to reset our completion date to the next quarter of this year. So we look forward to bringing that to you in Q2 of this year. With regards to our ESG initiatives, we are growing as we work to meet the ICMM principles we adopted. As we see it, the best way to support and uplift a community is to provide employment opportunities to those communities. In that regard, we have reached record employment and contractor numbers on both of our mines. Education too plays a very important role in uplifting the communities around us. So we and our partners continue to sponsor scholars, educational materials, refurbish classrooms, and we are even building a school in one of the communities near our LULO mine in Angola. You'll be able to read more about this in a sustainability report that will form part of our annual report, which we'll release to shareholders ahead of the annual general meeting. Moving on to the mine performance in 2022 and some guidance for 2023. As mentioned, we achieved a number of records at LULO, courtesy of record volumes, and a mine plan incorporating some better grade mining blocks, carats were up significantly by 44% to a little over 35,000 carats. The diamond sales during the course of the year achieved an average of $2,449 per carat. Please note that, notwithstanding our average price decrease, prices of diamonds did not decrease during the year on whole. The reduction in our achieved price is purely a result of different resource areas containing different qualities and sizes or populations of specials. That is one of the primary reasons we believe we have multiple influences or kimberlite sources on the LULO concession, which makes the prospectivity of the kimberlite exploration program so high. Those physicals transformed into a very, very strong financial performance at LULO, our second consecutive year achieving an EBITDA over 35 million US dollars, or in and around 50 million Australian dollars. For over 8 years, LULO has enjoyed the tag of being the world's best diamond production, and now that it is some 400% larger than when we first commissioned the mine in 2015, it is certainly paying record dividends to shareholders and record loan repayments to Lucapa. So with another strong financial performance from LULO this year, we could well see a large chunk of Lucapa's development loan to LULO repaid. So we look forward to that this year as well. Going forward, in terms of the physicals and some guidance, more of the same. I don't want to say it's boring, because certainly achieving $50 million EBITDA is not boring, but we are planning to be just shy of 600,000 cubes through the plant at an average grade for the year of 5.3 carats per 100 cubic meters, recovering approximately 31,000 carats. An estimated diamond price of $2,300 per carat. This will equate to just over 71 million US dollars in revenue, or just over $100 million dollars in Aussie dollar terms. Again, please, we are not forecasting a decrease in the diamond price. The prices are an aggregation of the value that we will be deriving from the various mining blocks that comprise the LULO resource, and we'll be accessing in the 2023 mine plan. I don't want to preempt the quarterly activities report that we'll be publishing in April next month, but I will say that we are tracking just fine compared to our plans so far this year. Having a look at MOTHAE, naturally, as we advised the market during the course of the year, we had mixed fortunes. But as you can see from the picture on the screen there as well, in the winter months, whilst it looks beautiful, it certainly does get very, very cold. Ahead of taking you through the next few slides, I do want to explain what mass balance or mass imbalance is. We've had a couple of questions on that subject, so I just want to very basically explain it to the audience. In a nutshell, we have 3 recovery streams in the plant at MOTHAE. We've got a DMS stream, a fines XRT stream, and a coarse XRT stream. When the actual volumes of material report to these 3 individual streams in volumes that are different to the design capacities, it can result in an imbalance. So when one recovery stream is at full capacity, but the other streams have spare capacity, that stream becomes a bottleneck, and if it's pushed beyond its capacity, it becomes less efficient in diamond recovery. So despite our tons treated achieving a new record of 1.2 million tons through the plant, as a result of contractor downtime, logistical constraints getting critical spares for their fleet and for their drill rigs, a different source of ore and mix, and the mass imbalance constraints that we faced, we had a lower grade, and MOTHAE recovered 5% lower carats at 30,740 carats. Diamond sales achieved on average a selling price of $690 per carat, marginally up on the prior year. Once again, not reflective of a flat diamond market, prices went up on the whole. What you see there is a reflection of the mix of the source of ore and some of the plant inefficiencies that we had during the course of the year, which I'll explain on the next slide. So all in all, a good operational performance, but unfortunately some constraints in the plant and with the contractor. Another significant challenge that was thrown at MOTHAE this year was the significant increase in the diesel price by over 50% to close to 22 Rand per litre. So all in all, with those challenges that we faced at MOTHAE, we achieved a $2.4 million EBITDA loss. I have on this slide also just want to highlight the impact of some of the key drivers that impacted earnings in 2022. I think once that I've explained the impacts of those, informing and showing you how we have addressed those, I will show you how we have corrected the plant inefficiencies early on in this year, and how we believe that we have corrected MOTHAE to return it to a value producing asset. So we've looked at the revenue, the mass balance and the contractor constraints resulted in us achieving 300,000 tons under our plan for 2022. At an average grade of 2.6 carats per 100 tons, that is a lower carat recovery of some 7,800 carats for the year. At the same average dollar per carat as we achieved for the full year on a net basis, i.e. net of royalties and marketing costs, it achieved, we were down $5.1 million on revenue. If you add that back to the EBITDA loss, you will see immediately that it returns MOTHAE back to a profit generating or an EBITDA positive situation. Adding to that, the diesel price increase and the impact that it had on our cash costs. The diesel price went from 12 Rand per litre to 22 Rand per litre high during the course of the year. On average, during the course of the year, it was over 50% higher than our plan. And when we consumed 5.9 million litres of diesel on the project annually, that resulted in an additional charge, unexpected charge, and an uncontrollable charge of $2.2 million. So all in all, those two drivers impacted earnings some $7.3 million. Now, in terms of the diesel price, unfortunately, that's not a controllable for us. I will note, though, that the diesel price has been reducing, so that is a positive. So in terms of an uncontrollable input, we're seeing a relaxation of the constraint that provided last year as well. However, the plant inefficiencies and the plant throughput is a controllable, and I will show you how we have attended to those. So we did a lot of investigations last year, a lot of modeling to see how we could optimize the plant. One way to optimize the value of the operation is to try and increase the plant capacity significantly. But increasing the plant capacity does require investment, additional and potentially significant investment if we want to go certain routes. But we didn't want to go down that route. Given that the government are discussing new tax legislation around the VAT and income tax, and that is not yet repealed, we decided to focus on obviously the lower cost routes in terms of improving efficiency. So instead of just focusing on capacity, we also focused on the value return from the capacity that we have, i.e. improvements of revenue per hour through the plant. From the investigations and the modeling that we did, we saw that if we discarded a certain size fraction out of the plant fairly quickly once it had gone through, we could release the bottlenecks in certain parts of the three streams. Together with an upgrade to the course XRT module during the course of Q1, we saw that this did release additional capacity, but we would expect, because we are discarding some of that material, we would expect a lower grade, but the grade would drop because we are not liberating some of the finer diamonds from that material that we discarded. But by discarding some of that material, it frees up headspace and plant capacity to process fresh ore and fresh feed that has a much higher dollar per ton contribution into the plant. So we made those changes during Q1, and I'm very glad to say that during the course of Q1, post those changes, we've already seen record throughput rates achieved on a ton per hour. We've already seen daily production records. The grade losses that were anticipated and modeled have been lower than the expectation, and we've certainly seen a much higher average stone size, which is great, and we are certainly seeing the impact on the average dollar per carat coming through as well. As I mentioned earlier, we've seen a diesel price reduction come down from 22 Rand per litre to around about 18.4 Rand per litre as we speak. And we're also starting to see favorable exchange rate movements where we were modeling between 17 and 17.5 Rand to the US dollar. We're seeing the Rand US dollar at over 18 for the last few months as well. So all in all, our expectations for 2023, we are forecasting plant throughput at around 1.4 million tons per annum, which is a 14% increase. As I mentioned, there will be an impact on the grade because we are discarding one of the less valuable streams in the plant. So grade will reduce to 2.1 carats per 100 tons. We will see a recovery of approximately 29,500 carats, which is also a slight reduction on the prior year. However, because of the smaller size fraction being discarded, we will see a significant increase in the average dollar per carat coming through as well. So if you do the maths there, 29,500 carats recovered at an approximate $1,000 per carat on average, we should return MOTHAE back to 29-30 million US dollars in value generation during the course of the year. So we believe the fixes that we have made during the course of Q1 are very, very good. We have seen the run rates already improve significantly in the plant, and we've seen the daily recoveries improve. We've seen the efficiencies within those individual streams, recovery streams, improve as well, because we are not feeding them above their capacities. So therefore, they are more efficient and effective at recovering the stone sizes that they are meant to. So we believe that there'll be a very, very good performance coming from MOTHAE this year. Importantly, I want to note that we have got 1 more month's worth of loan repayments back to the IDC in MOTHAE. So in the matter of some 30 odd days, MOTHAE will be debt-free when it comes to the IDC. All the loans owing in MOTHAE to anybody are purely to Lucapa. Any surplus cash generation that MOTHAE generates will come to us here at the center and will not go to financiers. So from that perspective, we're looking forward to MOTHAE returning to EBITDA profits and generating the cash that we know it can and bringing those returns back to the center. So 2023, we are seeing a very, very different performance from the MOTHAE operation. Moving on to the diamond market, because we are naturally dependent on what happens in the diamond space. I've put the diamond price index dating back to 1999 on the screen, and I'll take you through why in a moment. But do we expect the diamond market to be less volatile in 2023? The answer is yes. We are entering a sustained period of lower diamond supply. Diamond prices have already materially increased over 50% on average from the pre-COVID levels, and diamond production is maxed out at 120 to 125 million carats per annum for the foreseeable future. It will drop come the end of 2030. There are a number of large mines that are ending their life of mine and will be exiting the production status come 2030. So down from the highs of 170 million in 2002-03, down from the recent highs of 150 million in 2017, with retail luxury demand on the increase and natural rough diamond supply on the decrease, you're going to see positive impacts on diamond prices. I have gone back to 1999 because this one graph evidences the significant potential of a development at Merlin. You can see prices, the price levels around about 75 on the index, in early 99 to 2003, and we're dealing with prices at an index level of around about 300. So 4 times higher price levels compared to when Merlin was last in operation. So therein lies the opportunity to reignite an historic mine using a very innovative hybrid open pit and vertical pit mine development. which we believe will certainly extract value from the operations. The fundamentals in the industry are very supportive of prices rising going forward. We will always have cyclical highs and we'll always have cyclical lows during the year as we deal with the demands from the various centers. But on the whole, we believe that they will trend positively as they have done for the last 3.5 years, bar the blip in COVID in 2020. So given that significant price increase, it was with utter dismay that one then looks at the performance of listed diamond equities compared to the steep recovery in the diamond price. So the black graph is a shorter version of the diamond price index that you saw on the previous graph. It's indexed to 100 in 2018. And when you look at the price of the Lucapa share price, you look at GEM's share price, you look at Petra's share price, you look at Lucara's share price, and you look at Mountain Province's share price, there is a significant disconnect between where diamond prices have got to today versus where diamond equities are languishing. It's not going to last for very long. There will be a correction. This is the opportunity to get into the diamond sector at the ground floor. And we believe if you get into the sector with Lucapa, we will be a major deliverer of value going forward as this gap is narrowed. So finally, just on Lucapa itself, before we go to questions in the sector, Lucapa offers an investor a pure play multi-asset diamond company with significant exposure in very good assets right through the diamond value chain: exploration, mine development, production, midstream manufacturing as we stand right now. We've got 4 exceptional primary source exploration programs, most notably LULO in Angola, where we are at an advanced bulk sampling stage, recovering the very kinds of diamonds, large type 2As, that we are recovering almost at will in our alluvial operations. We are looking forward to putting through the remainder of our bulk sampling, our targeted high priority kimberlites through the bulk sampling program, because we do believe there are more results like kimberlites L164 in our future, and we look forward to bringing those to the market going forward. From a mine development perspective, Merlin is a very important project for us. It is transformational. It will turn Lucapa upside down. The production and the carats perspective, the production and revenue perspective, the cash generation, the earnings perspective will significantly transform Lucapa as a diamond producer. Importantly, please, we are not looking to go out and do a large capital raise that is dilutive to the shareholder base to deliver Merlin. We have a number of opportunities that we consider. We are looking to debt providers. We are talking with offtake providers, revenue stream providers and funders as well. And importantly, also partners. We have time on our side. This is a project in a tier 1 jurisdiction. We will make sure that we bring to the market the most valuable proposition to our shareholder base. We're not going to run out there and do something that we believe is detrimental to the shareholder base. So do trust that we will bring the appropriate solution to the markets in due course. With regards to our production assets, I have already waxed lyrical on LULO and MOTHAE, but to note that they are at the very top of the diamond quality tree. Very niche special assets in our space. There is only a handful of these kinds of mines that produce these qualities of diamonds, less than 1% of worldwide production. And, the majority of our production and value from our productions is in that category. High-end investment quality diamonds, which leads our foray into diamond polishing and manufacturing, to be very profitable. One stone can bring a lot of value as opposed to many smaller stones that we have to do on a volume basis, adding up to value. Individual stones add up to significant value here. We dipped our toe into this sector for a number of years now. It has been very profitable to both us and our partner from both the LULO and the MOTHAE operations. It's time to dip more than our toe into the sector. And in that regard, we are trademarking our chosen brand name through a number of key global markets. And once that is done, we look forward to growing that work stream quite considerably. I don't want to sound like a telemarketer here, but at the risk of doing so, Lucapa offers a significantly more than just its physical assets. We've got a very, very experienced diamond team, successful in exploration, successful in mine development, successful in cutting and polishing and midstream activities. We're very, very well experienced and will deliver on our projects. Lucapa is strengthening day by day. The balance sheet is improving as we knock down our debt. We have made significant inroads into reducing our debt and therefore our interest charge. And come the end of Q3, we will be debt-free. There are 90 million Australian dollars worth of loans owing to us from both LULO and MOTHAE, and we look forward to receiving those at the centre and continuing to strengthen our balance sheet and applying those to shareholder returns, as well as furthering our development assets. When you add all of that together, we do believe that Lucapa is best positioned to deliver value in the diamond sector, best positioned to deliver value from the ground floor. So it's time to get into the diamond sector, preferably in Lucapa, and hopefully we will take the elevator up together. So I think from that perspective, I will hand over to Candice now, who will go through some of the questions that we have received from the registration.
Thanks, Stephen. We have quite a few questions, many of which were covered in the presentation. We have some specific ones on Merlin, LULO, and strategy, and I'll try to consolidate some of the questions to keep this brief. With regards to Merlin, can you give clarification on the development cost and timeline for Merlin? Will you do it in an incremental step-ups using internal funding, or if going for the big dollar project, can debt funding do the job?
In terms of an update on the costs and returns, we will be providing that to the market in the feasibility study announcement and publishing the results thereof. So I don't want to preempt that. We will bring that out then. In terms of the options for development, yes, we are looking at everything. We are looking at a full-scale development. We're looking at a measured small, low capital in, and growing it incrementally over a period of time. In terms of the funding, I think I've outlined already the initiatives that we are looking at as well. So I think we have a number of ways in which to achieve value there for the company and our shareholders. So I think all in all, I've addressed that question.
To preserve some existing shareholder wealth, is the sale of the Lesotho asset, MOTHAE, an option before proceeding with Merlin? The Lesotho, and this is this person's narrative, the Lesotho asset is hated by the markets, overgeared and underperforming, unlikely to see its debt repaid within the mine's life.
Well, that's the nice thing about everyone can have a view. I do disagree with the sentiment there. Yes, naturally a way of raising funds for further development within the company are to look at the various assets that we have and see if we can achieve value through a sale rather than operation. Yes, it is something that we have considered. Yes, it is something that may be on the horizon, but we all know that selling an asset that is not performing does not achieve the best value for that asset. You have to address the issues within that asset. So if you do put it up for sale, you'd be able to get strong value for it. But as I outlined earlier in the presentation, we see a very, very different 2023 for MOTHAE. We love the asset. It is one of the best mine sites I have been on in a long time. We do see value coming from it, and we would like to operate it to return the significant loan that it owes to Lucapa.
When will LOM acquire a better percentage share of LULO?
I think that question may be referring to the kimberlite exploration. I think I have outlined where we are on that and the positive steps that have been made in that regard. So we'll be looking to the not too distant future, bringing out an announcement in that regard.
Kimberlite exploration, is there a confirmation of a tier 1 mine potential, or are you hiding the outcome until better percentage achieved?
There is always the prospect of a tier 1 discovery, and that is what we're working so hard to achieve. Are we hiding a discovery pending a better percentage? No. We're a listed company. We take our continuous disclosure obligations very seriously. Our partners on the ground know exactly the results that are coming out of each and every bulk sample. So we are not hiding anything in that regard.
When will you release the production and bulk sample results and receipt of distribution and loan payments?
I think in terms of receipt of distributions and loan repayments, we have been making those announcements as and when they are received. In terms of bulk sample results and results from our operations, we will leave those to the quarterly activity report, where we update the markets on all activities for that quarter. Naturally, if we do have strong recoveries from a bulk sample that we believe is price sensitive and requires disclosure to the market, we will bring those out at that point in time and not wait for a quarterly.
What impact, if any, on LULO operations or bulk sampling would Endiama's planned IPO be, noting that it holds other interests in other JV mining and exploration assets?
I think it would be a positive outcome for our assets. Certainly the global investor market that Endiama could potentially attract and put eyes on Angolan assets is very, very strong. So I think it would be an appetizing prospect and potentially bring eyes to Lucapa individually as well. So I think that their potential IPO down the line would certainly be positive for our operations in Angola.
Are you setting LOM up to be acquired by a larger competitor?
No, we are setting LOM up to be a successful diamond company. If it means that it is appetizing for a larger player out there, then so be it. But no, we are working hard to deliver value from our various assets. And if that results in an acquisition down the line, that is something that the board and shareholders will consider at the time. But ultimately, it'll be up to the shareholders to decide what happens there. But right now, we are purely focusing on delivering value from all of our assets.
How could the company award the CEO with a pay increase and performance shares given the shareholder wealth destruction under his watch?
Well, I don't think that I'm best positioned to answer that question. Perhaps that should be coming from our board. But safe to say that we have been through a benchmarking process with a reputable remuneration expert at the beginning of last year, where all the salaries through the group were benchmarked and corrected. So I'm not sure I can add anything more than that. I can just say that we don't start out the year looking to deplete value for shareholders. We start out with the best intentions in mind and look to try and grow what we can, and we deal with challenges as they arise. Outside of that, I think that we continue to work hard, and I think the management are fairly rewarded.
Okay, that's just about covers everything.
All right. Thank you, Candice. Thanks everybody for your participation today. Thank you for those who have sent in questions. And we look forward to our next webinar in due course, probably at the next quarterly, and look forward to those who will be attending our annual general meeting in due course as well. Thanks very much.